Toronto, a city built on ambition, skyline cranes, and the promise of homeownership. But in 2025, that promise is faltering. Across the Greater Toronto Area, for sale signs sit longer on lawns. Condos stand half-occupied, their glass towers reflecting a market in decline. And yet, something unexpected is stirring. Home sales are starting to rise again. This is the paradox of Toronto's housing crash. Prices are plunging, but activity is picking up. Behind those numbers lies a story of shifting psychology, economic recalibration, and fragile hope. In September 2025, the Toronto Regional Real Estate Board, or TRRB, reported 5,590 homes sold, an 8.5% increase over the same month last year. At first glance, that's good news. But the full picture is more complicated. Prices continue to fall. The average selling price across the GTA now sits at $1,059,377, down 4.7% from September 2024. The benchmark price, which smooths out extremes, dropped 5.5%. In a city where every square foot once felt like gold, that's a steep slide. Jason Mercer, TRRB's Chief Information Officer, puts it bluntly, while sales are up, they remain below normal levels relative to the number of households in the GTA. The market isn't recovering, it's readjusting. The first sign of that adjustment came on September 17th, when the Bank of Canada cut its benchmark rate by a quarter point to 2.5%. After months of tight credit and frozen deals, that move was the first real signal to buyers that affordability might inch back. TRRB President Alechia Barry-Sproul called it welcome news for homebuyers. Lower borrowing costs meant one simple thing: some households could finally breathe. For the first time in a year, monthly mortgage payments began to align closer to average incomes. That opened the door for buyers who'd been locked out since 2023. But it also had a psychological effect. After years of price escalation, followed by 2 years of sharp decline, many Torontonians were paralyzed by uncertainty. When the central bank moved, it signaled that the worst might be over, or at least that it was time to look again. Yet buyers weren't rushing blindly into bidding wars. They were negotiating hard. Across the region, sellers faced an unfamiliar reality. They were accepting offers well below asking price. With a flood of inventory and more than 19,000 new listings in September, up 4% year-over-year, the balance of power shifted. Homes that once sold in days now sat for weeks. Realtors reported a new pattern: buyers viewing multiple properties, coming back with lower offers, and getting them accepted. In the suburbs, negotiations grew even sharper. In Milton, Markham, and Pickering, detached homes lingered, forcing owners to cut prices by tens of thousands. Meanwhile, downtown condos, once the market's hottest commodity, became symbols of oversupply and caution. Across the skyline, lights in new towers burn out one by one each night, a visual metaphor for a market cooling by the day. Inside the city of Toronto, sales jumped 13.2% year-over-year, the biggest gain in the region. Outside the 416, the rest of the GT saw a 5.9% increase. Property types shared in that uptick includes semi-detached homes up 11%, detached up 9.6%, condos up 7.2%, townhouses up 4.4%. But this rebound is relative. Compared to the frenzy of 2021 and 2022, transaction volumes are still muted. For agents, the difference is night and day. Where once buyers lined up for showings, now the calls come slowly. Where offers once stacked 10 deep, today there might be 2, and one of them is conditional. The market has entered a period of negotiated realism. The era of irrational exuberance has given way to a new phase: measured acceptance. But nowhere is the downturn more visible or more personal than in Toronto's condo market. For decades, these glass towers defined the city's skyline and its investment dream. Today, they symbolize its reckoning. According to Canadian mortgage professional, Toronto's condo sector is pummeled and unlikely to rebound anytime soon. Buyers have retreated, cautious and calculating. Prices are sliding, and more inventory is on the way, with thousands of new units set to hit a market already burdened by emptiness. Annalise Cugliari-Allegridi, Vice President of Research at Royal LePage, describes it bluntly: "We have a glut of small units to 500 to 600 square feet, one-bedrooms or bachelors, often without parking. They're simply not what today's buyers want." People entering the market are older, she explains. They have partners, families, remote jobs. They need space, not a 20th floor micro unit with no balcony. The result is a two-speed collapse. Small condos are oversupplied and stagnating, while larger units and family-sized townhomes still find cautious demand. A drive-through downtown at night reveals the paradox. Hundreds of towers glow, but not all the windows are lit. Empty units dot the skyline. Investors who bought pre-construction at peak prices now sit on vacant apartments, unable to sell without taking a loss. Developers, facing rising construction costs and financing strain, have pulled back. Few new projects have broken ground in the past year. Kugliari Alagridi predicts that by 2027 or 2028, completions will drop sharply simply because so few developments are starting now. That shortage, when it arrives, could set the stage for the next price surge. But in 2025, the market remains flooded. And for those holding multiple properties, the math no longer works. Rents aren't covering carrying costs. Mortgage renewals are painful. And consumer confidence, once the market's engine, has evaporated. Behind every data point is a household recalculating its future. Meet David and Mira, first-time buyers in their 30s, both working in tech. 2 years ago, they paused their search after mortgage pre-approvals dropped by nearly $200,000 when rates spiked. Now, after the recent rate cut, they're back. They find a one-bedroom in Liberty Village listed at $639,000. 6 months earlier, the same unit was priced near $700,000. They negotiate $25,000 off, and the seller accepts. It's not victory, just relief. As Mira puts it, we don't feel like we got a deal. We feel like we finally stopped losing. That sentiment defines the market today, of a cautious optimism built on lowered expectations. Meanwhile, longtime owners face the reverse dilemma. Peter, 58, owns a detached home in North York. He planned to downsize and retire this fall, but his property, once valued at $1.7 million, now draws offers just above $1.4 million. He hesitates. Selling now would crystallize the loss. Waiting could mean further decline. For both groups, buyers and sellers, the ground keeps shifting. Economists call it anchoring, the tendency to fixate on past prices. Buyers still imagine 2019 affordability. Sellers still remember 2021 bidding wars. Reality sits in between and comfortable for both sides. TRRB data shows the average GTA home has lost nearly 5% of its value year over year. But few owners truly accept that figure until their own listing stagnates. Meanwhile, buyers hesitate, convinced that another dip is coming. In behavioral terms, the market is trapped in a feedback loop of hesitation. Every stalled offer reinforces the belief that prices will fall further. Every price cut confirms that belief again. Only policy or psychology can break that cycle. The Bank of Canada's next moves will matter more than any open house. TRRB's Jason Mercer suggests that more 25 basis point cuts could bring monthly payments in line with incomes. If that happens, demand could rise faster than supply, especially if new listings continue to decline month over month, as they did in late summer. But until then, the city remains in limbo. Neither crash nor recovery, just a fragile equilibrium built on waiting. Real estate in Toronto isn't just a housing story. It's an economic pulse. Every home purchase triggers a chain reaction: renovations, furniture, appliances, services. When the market slows, so does everything around it. Contractors see fewer calls. Movers, stagers, and home inspectors report cancellations. Even coffee shops near condo developments feel the drop in foot traffic. TRRB President Alechia Barrisproul noted that increased home purchases help stimulate the economy through housing-related spin-off spending. But that spending depends on confidence, and confidence, right now, is fragile. Canada's broader economy is navigating its own slowdown. Trade tensions linger. Job growth has softened. And in Toronto, one of the country's most expensive cities, housing affordability remains a national fault line. When the housing sector catches a cold, the rest of the city sneezes. Developers, once the risk-takers of Toronto's skyline, are now in retreat. Many pre-construction projects have stalled before breaking ground. Others have quietly extended timelines, citing financing constraints and soft demand. The economics are brutal, construction costs remain high, interest expenses eat into margins, and finished units sit unsold. A growing number of developers are waiting for clarity on rates, on consumer sentiment, on what comes next. Industry analysts expect the result will be a significant drop in new housing starts through 2026 and 2027. That pause, while painful in the short term, may be what stabilizes the market in the long run. As Cugliari observed, by the time we reach 2028, completions will fall sharply because there just haven't been any new starts in the last year or so. The irony is that today's oversupply could sow tomorrow's shortage. Toronto has seen this pattern before: boom, bust, rebound. By fall 2025, the city has split in two. In one Toronto, investors and sellers face declining values and rising anxiety. In the other, cautious buyers begin to see opportunity. Detached homes in the GTA now average about $1.31 million, semi-detached around $980,000, and townhouses roughly $860,000. Still expensive, but no longer impossible. First-time buyers who once felt permanently excluded are finally re-entering the conversation. Many are turning to smaller condos, despite their flaws, simply because alternatives remain out of reach. As Cugliari said, they don't have much other option except for condos. This market, paradoxically, is both more affordable and more unequal. Those with cash or stable employment can seize opportunity. Those with high debt or variable rate mortgages continue to struggle. Equity, once the great Canadian safety net, has become an even terrain. In East York, a retired couple considers selling their home of 40 years. Their mortgage is long paid off, but property taxes have doubled since 2015. Their children can't afford to buy nearby, and downsizing feels like defeat. In Scarborough, a young family rents a townhouse while waiting for prices to bottom out. They watch listings fall week after week and still they wait. And in Mississauga, a developer's billboard for a cancelled condo project still hangs over an empty lot, promising luxury starting in the $800s. The promise rings hollow now. Across the region, there's a quiet reckoning. The market isn't collapsing under panic, it's deflating under realism. But Toronto is nothing if not resilient. The city has weathered downturns before: the early 90s recession, the 2008 global crash, the pandemic-era volatility. Each time, recovery came slower than expected, but stronger than feared. Already, some indicators suggest the foundation remains solid. Active listings, nearly 30,000 across the GTA, mean buyers have choice. New listings, down slightly month over month, hint that supply may tighten soon. And while prices have dipped, employment remains stable, immigration continues, and the region's long-term demand for housing hasn't vanished. Toronto's fundamental challenge is structural, not a lack of desire to own, but a misalignment between income and cost. If interest rates ease further, that gap could narrow, sparking not another frenzy, but a more sustainable phase of recovery. The Canada Mortgage and Housing Corporation expects recovery only by 2028. That's 3 more years of slow churn, stalled projects, and price recalibration. But for some, that horizon is opportunity. For renters, it's leverage. For buyers, it's timing. For policymakers, it's a window to address what decades of growth left unresolved: affordability, supply, and balance. The next chapter of Toronto's housing story will depend less on speculation and more on pragmatism. If developers build for actual need, if buyers remain disciplined, and if interest rates normalize, the city could find its footing again. The Toronto housing market of 2025 is a mirror, reflecting both the limits of optimism and the resilience of reality. Prices have fallen. Sales are rising. Confidence is tentative. The crash hasn't broken the city, it's corrected its course. On the streets of Etobicoke, in the towers of downtown, in the cul-de-sacs of Vaughan, the same questions echo. Is now the time to buy? Should I wait? Will it ever be like it was before? The honest answer, no. And maybe that's for the best. Because beneath the volatility lies something Toronto has always had: movement, ambition, and the quiet certainty that the market, like the city itself, will rise again.